Good evening, ladies and gentlemen. My name is Jimmy from Ortiz Arts. Tonight's episode of Monday Money Talk with Mike will be tax. Oh, we got the echo. There we go.
All right.
It's going to be tax strategies. I apologize for the double talk and echo, ladies and gentlemen. I didn't pay attention to what's going on the other screen. But like I was saying, tonight we're going to talk with Money Mike about tax strategies. And without further ado, Mr. Macklin, how you doing this evening?
I'm doing better than amazing, brother. How you doing, man?
I'm doing well. You just came back from a trip to Detroit. You had a big conference. So how did that go for you?
Oh man, it was wonderful. The basically the conference was a big conference for the organization which I work with, which is My Econ. What we do is we're a personal financial success company. So what we do is we teach different financial strategies such as tax reduction, income increasing, debt reduction. We focus on teaching you how to fix your own credit. And we also, get started with, teaching you the concepts of investing, the different terminology, the concepts, how everything works. And, it's a wonderful, wonderful company. And, it's just a bunch of like-minded people coming together, just, talking about, how to bless others with, the financial information that's just not taught, traditionally in school. And, when you're able to lock arms, with people that are, making, seven, eight, nine figures. And, they take time out of their day, to teach, people like me and you these things. You don't want to miss those kind of opportunities. And, I'll kind of get into the advantages of, participating in events like this. But, without further ado, that's me. Just real quick, I forgot to do this at the beginning, but if it's your first time tuning in, again, my name is Mike Macklin, aka Money Mike. I teach financial strategies. The primary one is a strategy called income shifting, in which I'll touch on briefly in this interview. But just wanted to introduce myself, and again, Jimmy, thank you so much for having me on, brother. Always a pleasure to exchange ideas with like-minded people, and help promote one another in business and in life.
Indeed, indeed. It's always a pleasure to work, especially with someone that I've known for a while. If you missed the last stream, Mike and I were in the army together for a long time. So it's not he's a person that I've known for a long, long time, and so there's a trust and a brothership and a bond between us. And when I found out what he was doing, I figured that this would be an amazing opportunity to share some of this information with my audience and to help build his audience. So today we're going to be talking about tax strategies. I guess for 2018, there might be some things that have changed with the new tax codes that Trump or the Trump administration has put in. So, Mr. Macklin, take it away.
All right, all right. Again, thank you, Jimmy. Definitely appreciate this opportunity. Now, guys, what I want to kind of start with is I kind of want to get your mind wrapped around why tax strategy is important. Again, the traditional school of thought is you go to work, you pay taxes. It's the American thing to do. You owe the country taxes. As an American. Now, the problem with that is the average person. And when I say the average person, 80% of Americans, they don't have, they're not doing their taxes correctly. And what I mean is at the basic level, and that's your W-4. Now, if you don't know what the W-4 form is, most people should, but however, I like to be thorough in my explanations, so I'll get into that. It's basically your withholding allowance form. It's basically when you work a 9 to 5 W-2 job, your employer typically, either like right before you start or right after you start, they'll have you fill out this form, and this is what tells the employer how much of your taxes to take out of your check each month. So the typical thing that most people do is that they, they're wanting a refund, or they're just, not understanding, exactly what the form is and how to fill it out. So they go with the traditional knowledge of, okay, we'll just put, single with 0 if you're single, or, married with 0 if you're married. And that way, you don't have to worry about, the government, auditing you or writing you up or whatever. But the problem with that school of thought is you're basically giving the government money for free. It's money that belongs to you. You're a hardworking American, and you should be compensated properly for your time and efforts. And the second part of that, again, is you're giving the government basically a tax-free loan. Like, so they're basically using your money to make more money, instead of what you should be doing is using your own money to make you money. Because the goal at the end of the day is for you to take care of you, and you to prepare for your future and your retirement. So the W-4 is actually not nearly as confusing as what people think. Basically, like, it really, all you have to do is really read those lines and follow the instructions. And if you look in the top of the 2018 W-4, and most W-4s to begin with, but I'll say the 2018 because it's the most current, is very detailed, even at the top, explaining the benefits of properly filling out that form, and the negative implications of just not having that form filled out properly. Now, with that being said, again, once you go in there and fill out that form properly, it's actually two ways you can do it. You can either go line by line and fill out the form, or you can go onto the IRS site and fill out an IRS tax withholding calculator, and it'll kind of give you a roundabout guesstimate of what you should claim as far as allowances. And while I'm on that subject, I do want to talk about the difference between allowances and exemptions. Okay, exemptions are things like family and things like that. Now, allowances are additional write-offs for individuals who are in business. Okay, so that's important, because the the being in business, most people, they shy away from business because they feel like it's this complicated thing. But most CPAs will tell you, if for nothing else, for tax purposes, you should have some kind of home-based business. Again, just because, as the wealthy say, when it comes to money, it's not about what you make, it's about what you keep. Okay. I take an example, and I use this all the time. Let's say, me and Jimmy, we're two different employees. Jimmy he's a Fortune 500, IT specialist, and he's making, $1 million a year. And then there's Money Mike, who's, just, the average Joe. I'm a landscaper, for, Fort Bragg or whatever. And, I'm making like, $40,000 a year. Now, let's say Jimmy decides, okay, yeah, I'm making good money, so I don't need to, do anything with my taxes. I can spend, spend, spend. And, his expenses are, they match his income. So basically, he isn't making any money. He's basically just giving it right back to, whomever it is, the stores, the, tax, whoever. Now, Mike, he says, you know what? I'm not making a whole lot of money, but, I do have some great ideas. So what I'm going to do is I'm going to go ahead and, start me a home-based business. And the difference is now, because I'm a home-based business owner, a lot of the expenses that I'm going to, go out there and do anyway, they become tax deductions because they're now, considered related to my business. And what I mean by that is, a lot of the, normal expenses that, we go through every day, just to name a few, things like, a home, where you live, the vehicle in which you drive, having meals, going on different trips, the use of, your cell phone, your internet, just all the things that you're already paying for anyway. When you're a home-based business owner, these things now become tax write-offs. And the reason that is because, again, these are things that are necessary for you to operate as a business owner, a home-based business owner. You have to have a home to be a home-based business owner. You have to, drive to customers, in order to seek profit. You have to communicate with those customers via, cell phone or the internet, or, like Jimmy and I are doing right now, using, social media outlets, or, YouTube, in order to communicate. Even, like things like, hiring on a staff, are things, again, this is what's putting money back into your pocket. And that's the important thing. And that's what I mean by, keeping more of your money. And the way that works basically, is, again, you go at the end of the year, get ready to do your taxes. And, the tax person is going to sit you down and, kind of talk to you about, different, your situation, whatever your situation looks like life wise. Because honestly speaking, and what people don't understand is, the government is really looking to incentivize people, to, take up entrepreneurial things, or, do what the government wants you to do. And that's to stimulate the economy and to create jobs. And that's why most of the tax code is actually written. The common misconception is that, people think, the tax code is written strictly to take money out of your pocket, when in actuality, only about 5% of the entire tax code, and it's a huge book. I think it's like 600 pages, but only like 5% of that is actually towards, ways that, taxes come out for you. Most of, the tax code is written to explain to people, what the government wants you to do in order to be, get tax deductions or exemptions or credits, whatever you want to call it. And that's the important thing. And, one more thing that I didn't, kind of touch on, when I was talking about, life expenses is, taxes, first off, is your biggest expense that you will have. People don't understand that, and they ignore, taxes when they're doing things like their budgets and things of that sort. They just look at what they taking home. But what they don't understand, again, getting back to the point of what you keep, is when you just disregard your taxes, you're making a huge mistake, because again, you're letting money get away from you. Money that isn't watched, money that isn't tracked, is basically money that ends up gone. Now, another exemption that I wanted to talk about, or write-off, should I say, that I wanted to talk about, is one of your second most expensive expenses, and that's your children. Okay, you got to think about all the things that you spend money on for your children. The clothing, the shoes, all these little things that they want now. The iPads and iPhones and Apple X's and all this different stuff they want now. And the tax code, when you're a business owner, it incentivizes you, again, because you're now creating a job. You hire your child on to work in the business with you, and now you've basically created a job, and the government incentivizes you by allowing you to write off a large amount for your children. And the large amount I mean is, according to the tax law, the child tax law, a child can be paid $6,300 a year, absolutely tax free. And in addition to that, also, you want to also, have an IRA for your child, or a retirement account. So you get an additional $5,500 a year for that, which is also now tax deferred, meaning you can pay your child nearly $12,000 a year, and that is a tax write-off for you. And the way you can do that, I mean, it's very simple. The way in which you justify your expenses is actually very simple. Now, for hiring on your children, it's a little bit more than just the average business expense you have, but it's still very simple. Basically, all you have to do is you'll open an account for your child. A custodial account is what it's called. So you basically have control of it along with that child. Now, in most cases, depending on the age of the child, you don't want to give the child, control of that account. You just want, what I'm saying, to, monitor them and teach them about money. But what it allows you to do is you open that account and then you can make, deposits from your checking account into, your child's checking account. And what you'll do is then those deposits, you'll make sure you want to, keep those or annotate those as, business expenses. And, at the end of the year, as long as you have those deposits, as well as anytime you hire a child on as an employee, you must have a job description written up in which the child signs, as well as, do timesheets and a job offer. Now, that sounds difficult, but it's actually very simple. I mean, a simple spreadsheet and, a simple Word document, sign, most of these children, depending on their age, and, now in schools, they're not really teaching them how to write in cursive. But, as long as, there's something down there, their name written, that counts as a signature. And now you have that paperwork together and you're good to go. Should the IRS audit you? And, while I'm on that point real quick, I'll touch on, the whole concern with audits. First and foremost, it shouldn't be as big of a concern as people think, because, the IRS doesn't really have this big squad of people like, we think they do. And traditionally, only about maybe 2% of tax returns are audited. And within that, a good way to, prevent any, kind of auditing is you want to avoid red flags. And some of the red flags, the prominent ones are, let's say you make $50,000 a year, but, on your profit and loss statement, or the Schedule C, as is, actually called, you put $70,000 as expenses. They're gonna be like, okay, how did you make 50,000 but had 70,000 expenses? And like, yeah, no, we're about to audit you. You know what I'm saying? Because you basically set yourself up for that by being greedy. The common phrase, when it comes to avoiding that is, pigs get fed, but hogs get slaughtered. So you want to make sure that, again, you operate ethically. Again, you're a business person, or just any person. You want to operate within ethics. You don't want to try to get over on the system, because trust and believe me, as a 20-year veteran that's working in the financial field, I have seen so many people get prosecuted, spend time in jail, end up owing hundreds of thousands of dollars because they thought they were getting away with different fraud. And when I tell you the government keeps excellent records, they keep excellent records. So you don't want to go out there trying to skim the government, or operate outside of the laws, because they will find you and it's not going to be pretty. Okay. So with that, I mean, that's the kind of the long and short of tax strategies. I will say this: a few changes this year that's kind of prominent. Um, a few things actually became, not tax deductible like it used to be. And one of those things is entertainment. Once upon a time, you can, take somebody out to a football game and write that, football ticket off as a business expense under entertainment. Now the government is kind of cracking down on what they're, saying is, considered a business expense versus, a personal thing. So, the entertainment kind of, something that fell off this year. And also, as far as deductions go now, they took away the two-part, deduction, where it was like the standard deduction and then like another like $2,000 deduction. And they've combined that now. And now the standard deduction for a single person is $12,000. For a head of household is $18,000. And then for a couple that's married filing jointly, they are allowed to take $24,000 as a standard deduction. Now, another thing that I want to talk about as well is the head of household, because it's the subject of a lot of confusion. And I think I touched on it on the last interview I had with Jimmy. A lot of people, they want to say, oh, like especially married couples, oh, I'm the man, I'm the head of household, so I'm going to claim head of household. Guys, it does not work that way. First and foremost, just the fact that you're married already excludes you. You cannot claim head of household. Okay, head of household is basically reserved for an individual who is single and taking care of dependents, whether it be children or parents. If you don't, satisfy those two things, both, not one, but both, and actually it's a third thing. Um, but if you're not within those three, categories of, being single, taking care of a child, and I'll have to look at my W-4 real quick to get that third contingency here. So bear with me for like 2 seconds here while I open my book up here. All right, head of household. Generally, you can claim head of household filing status on your tax return only if you are unmarried and pay more than 50% of the cost of keeping up a home for yourself and your dependents or other qualified individuals. And a source that you can look at, guys, is Publication 501. That's exemption, standard deduction, and filing information. So if you want to go back and, double check my work or, make sure that what I'm saying is correct, those publications are what you want to use. And that's something else that I want to touch on as well, is anytime that you're looking at making tax deductions and things like that, you want to look at those publications because they spell it out for you guys. They tell you exactly what it is that kind of qualifies for a deduction. And the basic qualification for deductions, just to kind of put it out there, is it has to be related to the business. It can't be lavish, okay? And it has to have something to do with that business. It can't be something off the wall, like what I'm saying. If you're in let's say you have a home-based business where you make sweaters, and you're trying to take deductions for, I don't know, like rocket fuel. I'm like, what does that have to do with making a sweater? And again, that's the things that'll get you audited when you start going outside of the realm of what is related to the business. Again, it can't be lavish and it can't be something that's unrelated. So along those lines, okay, you go out to eat with the family, that's wonderful, but you got to keep it within reason. You can't go out and spend like $2,000, and just you and the wife, and expect to write that whole thing off, because it's going to look like, okay, why did you need to go to such a lavish place just to sit down and talk about business? It's not going to be a good lookout for you. Okay, so with that, I mean, I kind of just wanted to touch on those things real quick, and at this point, I kind of want to open up for some questions that may be out there, and I also will recommend a book once we kind of go through some questions.
Sounds good. So we'll go ahead and open it up for questions. If anybody out there has any questions, there's a little bit of a lag between what I say and when people start typing. So just give it a second. But kind of the thing that I found interesting was being able to hire your own child onto the home business. Is there a law from state to state that varies? Or is this just something that's across the board?
No, that's a federal law. So basically, like I said, again, it's just basically the child tax labor law. And it basically says, again, that, you are able to pay a child up to $6,300 tax free. Now, if you pay them any more than that, then obviously that opens up now to being taxed. But I mean, again, depending on how old your child is, I mean, why are you going to pay them that much anyway? They don't really need that money right now. Like,
no, I was just finding it interesting. That's something that, man, I have 4 kids, man. I could have, yeah.
Exactly. And that's something else I wanted to touch on. I'm glad you brought that up. This is, it becomes really powerful, when you understand that. Because, let's take, for instance, let's say, there's a lot of single mothers out there these days. You know what I'm saying? And,
right.
They're not really making a whole lot of money, or if they are, a lot of it's going back, to those children, being that, they're the sole provider. They're the only one there kind of taking care of them. So, for like, let's use a quick example of, a single mother. She decides, you know what, I got some great ideas. I'm gonna go ahead and start me up a business. Now, again, the first thing is, she's able to adjust that W-4 now, and she gets more allowances because as a business owner, it opens up that second. Well, I think now it's like a third page of the W-4 because the W-4 is now 4 pages, and most people don't even know that. All they know is that first page of the W-4. They'll basically, look at lines A through H, and then they'll fill out the bottom and sign it. But individuals who own a business are also able to open up that second page, and there's a line on there, I believe line 4, where it basically says, okay, put an estimate of what your business expenses will be that year, and based on that number divided by 4,150, that ends up calculating to more allowances. And that's how you're able to open up yourself. Like, let's say, again, a single mother with 2 children, traditionally she's at the most only going to be able to get like maybe, 6 allowances. But now that she's a home-based business owner, that opens her up from anywhere to, 10 to 12. I've seen as many as like, 13, 14 allowances. And, that's huge. That's a huge amount of money. And a lot of times, coming back into your paycheck, we have so many people that, they're like, oh my gosh, money just not looking good. I need to get a second job. When realistically speaking, you have money sitting right in front of you, but because you're afraid to, fill out that form properly, you miss out on that money, and then you end up driving an Uber or, working somewhere else, and you're giving away more of your time, to an organization versus, having that time with family or whatever. But getting back to the single mother now, so she decides she's going to have her a home-based business. Not only does she open herself up again to additional allowances, but then her life starts to become tax write-offs. So, the meals that she eats, now these are meals out. Now, groceries doesn't count. Okay, that's not a business expense. That's a personal expense. Like, there's no way you can justify buying groceries for your house just for regular consumption as a business expense. Now I will caveat that and say, let's say, you host a barbecue and you go out and purchase, meats and, different things of that sort. You can write that off. Let's say you have a business presentation while you're at the barbecue. You can then write that off as a part of, the event. But anyway, so now the mother writes off her life expenses, the home, the vehicle, the electricity, the cell phone, the internet. But then she says, oh, I got these 2 able-bodied children. Now the ages are between 7 and 17.
Right.
That you can actually pay your children. So I mean, you can't have a 3-year-old being, your secretary or personal assistant, because they mind barely is, good enough to do a whole lot. So tax law not gonna let you get it. But basically once they hit 7 and better, it's all day. And you can have those children do simple things like, just chores around the house. You can consider that, again, you can hire them on as a custodian or, a personal assistant. They clean up the house, or, they shred paper for you. Or you can have, your kid answer the phone for you. You can say, okay, my kid's my secretary. Or you can have your kid, track your receipts, and you can call that a bookkeeper. Like, a lot of these kids now, they're smart on social media. You can let them do your social media marketing for you, and you can pay them as, your marketing person. So, I mean, your children don't have to do these like tedious back-breaking tasks, but you can still, pay them a wage and are able to write that off on taxes. Now, just using, again, let's say that single mother makes, $50,000. And now, first and foremost, she's head of the household. So she gets, $18,000 credit. And then in addition to that, so, that 50 minus, that 18, she's already down to 32. So now let's say she hires on both of her children. Her children are, 7 and 10. So she hires both of them on, and she pays them each, $7,000 each. She'll pay $6,300, just, for, their work. But then she also, puts, $700 a month $700 a year, excuse me, into an IRA for them. Okay, so now IRA again, that's tax deferred, and then the child labor law says you can pay $6,300 tax free. So essentially, now you're giving your children $7,000 tax free, and both $7,000 now come off of your taxable income as well. So now remember, we said that we were at 32,000. Now you take another 14,000 off that. Now that person is now their adjusted gross income is $18,000, and that is a huge difference in taxes. And not only that, now once you get under a certain threshold, let's say she went a little higher and she paid 9,000 for each child. You know what I'm saying? So now her tax liability went down another 4,000. So she's at like 14,000, which is nearing now that limit to where you're at with the earned income credit because of the amount of money you're making. So not only does she save all of that money, she's now able to take advantage of that earned income credit, and the refund is even bigger. Now the great part about that is, again, when she fixes her W-4 the right way, she's already getting money up front. So she can take care of different bills much easier. And then even on the back end now, again, because she understands the tax law and the strategies, she is now able to, again, she's only at $18,000 now, adjusted gross income. So that's what they look at and say, okay, that's your income. That's what we're going to tax. And that will put her in nearly the lowest tax bracket. She'll be in like the 12% tax bracket versus if she was just at $50,000, she is at the 22% tax bracket. So she's already saved 10% on, taxable income. And that becomes huge. This is how, you open yourself up to so many more things. Like I hear so many people say, I wish I could, save or invest, but I just don't have the money. But when you're able to, to properly do your taxes, now you open that money to yourself, and now you're now able to do those things that you would like to do. And you're preparing yourself for your future, not just you, but also your children by having those IRAs open for them. And that's the name of the game. That's what the wealthy are doing. They're,
Indeed.
not only taking care of themselves, they're taking care of their children. And their children learn the exact same thing and do the exact same thing. And that money stays in that family until, forever, for all of time.
Till it becomes old money.
Exactly.
So you have two questions. One from Miss Thang. Is there a way to write off your children's clothes, food, and diapers as a business owner since I paid my kid up to $6,300?
Yes, there is. And basically the way you do that is, again, you have that custodial account. You make the deposit into that child's account. Make sure you keep a record of that deposit slip, because that is what the IRS, should they audit you, they're going to be looking for deposit slips to verify the amounts that you said you paid your children. Now, the thing about a custodial account is it's your child's account, but it's also your account, meaning you have control. So right after you do that deposit, you are well within your rights to take that money right back out and make the purchases for your children's clothing, whatever it is, because by law you've already paid them. And again, as that custodial parent, you have control over that money. All the IRS is going to look for is those deposit slips. They're not going to look and say, okay, I see withdrawals, because they're not privy to that. They don't need to see withdrawals from the account. All they need to see is deposits saying you paid your child, which is the law. And that's how they're able to still buy your children what it is they need to get. But you're getting a tax advantage because you show on paper that you paid them a wage.
Nice. So if I get this correct, you hire your child on, you show proof of deposits into a custodial account, which is I had one of those with Junior, but I wish I would have known this sooner. Then for any expenses that your children may have, you use the money that you paid them to hold so they can buy their own. Basically, you're using the money you paid them to buy their clothes, diapers, and food. So they're basically just living like a small adult, only
Right.
you're managing all the money.
that though, like diapers, I mean, that wouldn't count because I mean, if the
No
child
diapers?
is young enough for diapers, they're not old enough for to be.
Right, because they got to be 7 to 17.
Yes, but
Right.
anything other than the diapers, like I said, the child has to be of age to work in order to do that. Now, if you have a small child, unfortunately, you're not able to do that just yet. But once they
Right.
become 7 or better, then you know that you are now able to do that. And I'm hoping Miss Thing that answers your question.
Yeah, we'll give her a minute, and while she's well, the chat is catching up. You have another question from Mrs. Ortiz regarding the North Carolina income tax cap amendment. Do you support the lowering the maximum allowable state income tax rate from 10% to 7%? Please explain why or why not.
That's a little bit outside of my realm of information. I'd have to like read up on that a little bit more. So unfortunately, I can't really comment on that one. I don't want to tell you something and be wrong. So let me get back with you on that one. Let me read a little bit more up on that. But yeah, that's an excellent question. I thank you for it. So Jimmy, make sure you remind me of that question so I can get back to your wife about that one.
Once we get an answer, we'll put it in the comments below. So you can always refer back to the video and give us a few days and we'll put it down there.
There we go.
Do you need an EIN to validate your business?
It depends. Okay. If you are a limited liability company, yes. If you are a sole proprietor, no. And let me kind of explain the difference in the two. A limited liability company is what's called an incorporated company, meaning you have to go through the Secretary of State and apply for a employee identification number. Typically, I say you only need to open up an LLC once you have a certain amount of assets. Like if you have like, let's say that you're a real estate investor and you have, more than 3 properties. The reason that, most people decide to incorporate is because they basically want to, basically have what's called a corporate veil. And what that is basically a wealth protection strategy. So let's say you own 3 houses, and let's say, one of the houses you own, Jimmy lives in, and it's cold one day and it's ice on the steps, and Jimmy slips and falls and breaks his leg on the property. Now Jimmy is well within his rights to sue you, and but what happens is, being that you're not, that home is owned under a limited liability company, that individual basically has what's called that corporate veil, so it protects that person from their personal assets being seized. Okay, so this is the way like a lot of big businesses prevent from paying out things, because they have way more money to fight these legal cases than the person that's trying to sue them does. So what they do, that LLC, what they'll say is, okay, well, first off, these things aren't mine because it's under the LLC. So you trying to sue me personally, you can't get it because I don't own it. And then, if that person, also has a partner in the business, like let's say, Jimmy and his wife, open up a business and they incorporate and they have an LLC. The wife is in most cases, if he's smart, he'll have the wife be a majority shareholder with 51% interest. And, then now she's like, well, listen, you gotta, both me and my wife have to agree, to part with this asset. And if the wife says, okay, I don't want to part with the asset, you now have to, fight even harder to try to, get to that money. So long and short of that is, you're creating a wall against your personal assets being taken if someone sues you. In a lot of cases, it's going to be so costly for that person to really try to go after you that it's not going to be worth it and they're going to give up. Now, the sole proprietorship, that is basically you're the only owner. You have all the responsibility, you make all the decisions. The great thing about being a sole proprietor, one, you don't have to have an earned EIN or employee identification number because it's just you. And two, with a LLC, in a lot of cases, you have to have like accounts in that company. So, I mean, you can't use your personal money inside of an LLC. Now, in a sole proprietorship, on the other hand, you can use whatever money you want. Like, you know what I'm saying? You're the business. So, you know, whatever money is there is your money to use for that business. So that's why I say when people are kind of just getting started out, it's just best to have a sole proprietorship, you know, kind of, you know, get your footing. And then, you know, once you start to, you know, do well and see really good profits, then you incorporate, because then those expenses actually become worth it. And it's something that will help you in the long run protect your wealth.
Yeah, that that's definitely interesting because, like you were saying, it makes a difference what kind of business you start out and that what you're gonna do with it. Because there's definitely a bad step and you get sued, and that's the end of everything.
Yep. And it happens a lot, you know what I'm saying? When people don't understand the laws and, you know, they go into business willy nilly, and, you know, it's too easy to, you know what I'm saying, someone to sue you. And the way that they look at that is they say, okay, what could that person have made had they been healthy? And that's kind of how they kind of calculate, you know, what they're going to pay that person out is their potential income they could have earned over, you know, however many years. Like, let's say you permanently disabled this person. So that means, let's say, for instance, that person was 30 years old and, you know, now they're permanently disabled. They can't work anymore. And then so they'll look at that job that they had. Let's say the job was paying them 50,000 a year. So they'll say 50,000 a year times, you know, the next 35 years, you know, towards retirement. Okay, that's a good chunk of change that you would end up owing that person simply because you've prevented them from being able to make income now. And
Right.
that's how the legal system determines what they're going to pay out as far as a settlement.
Yeah, that's what we used to call salation payments.
Yeah, exactly.
Yeah. Yeah, salation payments when we were in the army and we had to go out to the villages whenever a house got accidentally blown up or a donkey got accidentally killed in crossfires. We would have to go out and give salation payments to the villagers, and it was based on the same calculations that Michael is talking about. So that's how I know it, escalation payments. If anybody else has any more questions, please feel free to ask. I want to ask in the very, very, very beginning,
Mm-hmm.
you mentioned how claiming single, excuse me, that Puerto Rican came out. Uh,
Yeah.
you mentioned how claiming single and zero, if you didn't have to, is like giving money away. So if you're in a high tax bracket, how do you, and you're not, and you don't have a small business or a home business, how do you keep yourself from overpaying taxes?
Well, if you're in a high tax bracket and you,
Yeah.
again, basically what you want to do, there's no reason, I don't care what tax bracket you're in, to claim zero exemptions. There's none. Because the very first line A, it says to claim one for yourself. So at the very least, anybody, regardless of their financial, you know, status, can claim one. And trust me when I tell you, it's not going to be a huge, you know, like dent in the tax thing anyway. But you know, again, this is how, you know, most individuals, you know, end up missing out on a good amount of money, you know, because typically, you know, depending on your situation, you know, how many kids you have, again, like, you know, you have multiple children, the government incentivizes that. And, you know, with the new tax form, you know, they're allowing you to take out even more allowances per child than they did last year. You know, last year, you know, for instance, let's see, let me find this one where, yes, the child tax credit. Last year, you know, they were only allowing you to take, you know, two allowances per each child. But now this year, you know, depending on the situation, you're able to take up to four allowances per each child. And, you know, those allowances, again, is, you know, what reduces the amount that the employer takes from your check. So in the instance of someone with a high income, it may be best, you know, to kind of, you know, leave that, let them take that amount out because it reduces what you end up paying at the end of the year. Because realistically speaking, one or two things, the real goal, honestly, is just to pay the amount that you actually need to pay in taxes and come out even at the end of the year. That's like the ideal situation to be in. But, you know, if you're like a high income earner and, you know, you're going to be in a situation where, you know, taxes are going to eat you up, there's nothing you can do about it. What you can actually do is there's a portion on the form that allows you to do additional withholding. And, you know, what you can do to offset, you know, the possibility of owing is you can pay additional withholding, you know, throughout the year. And then again, once you get to the end of the year, you break even. And, you know, typically if you're smart with your money, you've already allocated, you know, that money already and said, okay, well, listen, I know I'm going to owe at the end of the year, so I might as well go and let them take it. And it's not going to put a dent in your pocket. It's not going to be something that's a concern. So I would say for a high income earner, you really want to look at that tax calculator and, you know, figure out what you need to do in order to break even, because that should be your realistic goal.
Nice. That's definitely something to take into consideration. Because I just my greatest fear is owing the government at the end of the year.
Completely
So
understand.
I try to do whatever possible not to owe them.
Right.
Unfortunately, North Carolina always gets me for something, you know, not a lot, but just every year, North Carolina always manages to stick it to me, you know. Fortunately for me, it's like a couple of $100,
Yeah.
nothing outlandish.
Exactly what happened to me last year. A couple hundred. In anything this year, but I mean last year, yeah, they got
Yeah, North Carolina is tricky, man.
yeah, they are. They are.
Well, ladies and gentlemen, if you don't have any more questions, we're gonna go ahead and close the stream out. I want to thank Mr. Michael Macklin for joining me again.
Very
Um,
welcome. Thank you for having me, Jimmy.
if y'all want to continue to see this kind of videos, reach out to Michael Macklin or myself. All my social media is at the end of the video. Michael Macklin's social media is also in the descriptions. Um, Reach out to him. Tell him what you want to hear about. And then if the response is big enough, we'll have him on again next Monday. The goal is to have him on as many Mondays as possible to continue to give this information out. But the information is not for me and him; it's for you guys. So the more interest you guys show, the more interest, more participation, the more worth it is for us to come out. Of course, the video will be recorded and you can watch the replay to your heart's content. That's not a problem. But just reach out to us either in the comment section or get with Mr. Macklin in his social media or get with myself through my social media. Let us know what you're thinking. Let us know what you yes, bring him back on. The info is very valuable. Miss Thing, we will bring him back on next Monday. Just let us know what you're thinking about, what you want to cover. The poll that we had this week was tax strategies and debt consolidation. Tax strategies won out. We can definitely do debt consolidation next Monday. It'll be again at 8 o'clock. We're trying to make it consistent at a time that is decent for everybody. Monday works because it flows with Money Mike. We're just
right.
giving it the triple M treatment.
There we go.
Just giving it like a nice little slogan. But definitely just reach out to us. Let us know what y'all are thinking about. We greatly appreciate it. We do this for you guys. We're trying to build Mike's channel up on his YouTube. So eventually he'll be giving this information out on his own. But for now, I enjoy having him on. You know, like I said, I've known him for a long time, probably almost 18, 20 years.
Yeah.
You know, I mean, he was a kid when I met him, like 19 years old.
Yeah.
So, you know, we've been working around each other for a while now, and we enjoy doing this. We want to give out good information. We want to make sure everybody's good to go. And I just on this stream alone, my wife and I learned so much, and I am so grateful to you, Mike, for the information. You have no idea how much it means.
Happy to help, brother. Yeah, like I said, Jimmy, I've told you kind of in some other conversations, I'd be more than happy to really sit down and really give you guys the spill. So
yeah, definitely. Well,
real quick as well before we let our people go.
Yes, sir.
Another way to reach out to me is I try to make this as easy as possible to get to me. You can go to www.moneymike313.com. And I actually got some great information on that site. I just asked that you leave a name, a number, and an email, and I'll personally reach out to you and get you some great information, and get you started on the path to financial freedom, because this is our goal. This is my goal. Is I want to bless at least in the next 2 years. I want to bless at least 1,000 people with financial freedom and debt freedom. So that's my goal, and the only way to accomplish that is through things like putting out great information, and you just let's putting out the real, not the fluff, or that craziness, the get rich quick stuff, because I'm not that guy. So don't come looking for me saying hey, how do I make $1 million next week? I'm not the guy for that. I'm sorry.
Yeah, we discussed that on the first video. This is long-term strategies for financial wellness. Everything worth doing takes time, ladies and gentlemen. Everything, exercise to get your body right. Marathons, do you have to train for those? Everything takes time, and of course, it's about changing your mindset, your mentality, how you think, and empowering yourself to believe in yourself, invest in yourself, and move forward with confidence, and be able to live the life that everyone was meant to live. Not just a few elite. Everybody can have a very fruitful life. You don't have to have millions, but you just have to be smart, a dutiful custodian of what God has given you, and you will be fine.
Amen.
And I just wanted to say before we jump out, if you enjoy this material, and it helps me a lot if you like, share, and subscribe if you're not subscribed to me already. Subscribing to me and hitting the bell icon would definitely alert you the next time I stream. For the Money Mike streams, I usually go on Facebook and set up an event, and I go on Twitter and set up an event there as well, to allow people time to plan for it. But if you're already on these streams, I'm telling you right now, it's going to be Mondays at 8 p.m. Eastern Standard Time. Put it on the calendar, and like I said, all the ways to reach us are in the description. All Mike's, including his Instagram, his moneymike313.com, and his YouTube channel, which we're trying to grow, is on there. My Twitter, my Instagram, my Facebook, it's all down there. And of course, you can leave comments in the comment sections. I read them, and I'll definitely get back to you. But like I said, if you hit like and share and subscribe, it really, really helps out a lot. The more likes and the more shares, the algorithm in YouTube pushes this video up, and the more the video gets pushed up, the more eyes it gets to, the more people it can reach, the more people it can help. So it's not just for me. I'm not asking you to do this for me. I'm just asking you to do this so the information can be pushed out to other people that need it. Again, I thank you all so very much for joining us and staying on for this hour. And Mike and I will talk about next Monday and see what we can come up for you guys. We're always going to come up with something interesting to keep you going forward. I hope you all have a blessed evening, and I will see you all next time.